All right. Okay, so we started talking about the strategies for success, right? And Mark has already taken you through all of these, for that matter, and in detail about really picking your projects or your PSPs. Because the first thing that Mark talked about previously was really not to put your organization as a whole in front of a certain funder, but to think about different projects or your products, services, and programs within your organization that you can take to different funders and unlock different types of funding. So that with that being covered, what we're going to talk about now is understanding your different funding options. Because firstly, you identify the different projects. There are also different funding options that are better associated with each type of project. I'm just going to take you through that in a minute. So every type of funding is better suited to a particular type of project. And that's what you need to identify once you know what are the different projects that you want to fund. And the last is how do you really do that mix and match? So let's just go through this in a bit more detail. So if you remember for Access Afia that Mark had talked about earlier, I'm just doing a quick recap on what had they highlighted as the PSPs. One was the vaccination program, which was to vaccinate 10,000 children. Then there were the micro clinics, which was a service. And then you had the pharmacy, where they give out medication, which is the product that they're selling to the customers. Now let's go through the different types of finance. And these are the financing options that are typically available to a social entrepreneur. And we had shared a video with all of you earlier, which talks about the theory behind each of these options and what are the pros and cons and so on and so forth. So I hope you've seen the video, but if not, please do go back and have a look whenever you have the time. Because what I want to cover here is more the practicality of it. When you talk about equity, what kind of projects is equity better suited for, rather than going into the details and the theory of what equity is all about? So traditionally, we have these financing options. We're all aware of what equity and debt are. These are primarily investments, which means that only for-profit organizations or organizations that have an embedded commercial part embedded within the organization, which raise revenues, can go in for these kind of investments. Because any investor who comes in and puts equity or debt in your organization requires, or at least has an expectation of getting the money back with some sort of a return. So only if you have a part of your organization that generates revenues, that has a business, can you go in for the option of equity or debt. And the next is philanthropy, which we are all very well aware of. And then I'm also going to talk about crowdfunding and sponsorship. So as I mentioned, what I really want to talk about now is, when we say equity, what is it best associated with, or what is the best type of program or service or product that attracts equity capital? So equity is best suited for as growth capital for risky new programs or services with high growth potential. So equity investors come in, they're happy to take risk, but what they want to see is growth potential in the future. So equity is best suited if you have a new program or a new product or a new service for which you need capital to grow. It is risky to start with, but there is a potential for profitability to come in at a later stage. So that's what equity is best suited for. Next is debt, which is basically loans. And when you talk about loans, any lender firstly would want their capital back. There is no high expectation of profitability in the future, but they definitely want their capital back with a certain amount of interest. So loans are better suited for those businesses which are more stable. So or those parts of your organization which are more stable, which generate more stable income. So more mature parts, for that matter, which have broken even, and they can generate that level of income for which a debt lender is comfortable in seeing, and their visibility that, okay, in a few years I will be able to get my debt capital back. Or if you have some secured assets which you can give as security in the form of collateral, which if push comes to shove and you're not able to give the money back, the lender can then monetize and liquidate those assets for it. And then we have grants, which are for programs that cannot generate income. So there is no revenue for these programs, and definitely this money cannot be paid back. So for those programs, it's grant capital. What I also want to introduce to you are two different types of sources of funding that you can avail of as social entrepreneurs. So the first one is basically crowdfunding. So crowdfunding is a very popular way. It's actually increasingly popular way to raise funding, and how it works is in a very simple way. So you go to a crowd and you basically ask them to support your cause by giving funds. It is also a very good way to sell your product early. So if you want to test the market, it can essentially be customers who pay you in advance for a product that you're going to manufacture. So it becomes a good way of really a pre-sales or testing your market as well. But then what you really need for a crowdfunding campaign to be successful is basically a crowd, right? So you need an existing fan base that you can reach out to. And if you have that fan base, by all means, you should go ahead and use crowdfunding as an option to raise capital, because it takes a lot of effort to do that. And if you can you go out with a particular campaign, you can raise money around it, but it will only be successful if you have an existing fan base that will come in and support you in doing that. So let me take you through an example of an organization by the name of Donors Choose. Now, this was, I would say, the first organization that started crowdfunding much before Kickstarter and the others came along. So this was started by a school teacher whose name was Charles Best back in, I think, early 2000s. I think it was the year 2000 in New York. And he was a social sciences teacher. And what was happening in the school was that for different projects, or for small little like getting some books for children, or taking them out for an excursion, the teachers had to dip into their own pockets to pay for that, because the school wasn't providing them with any funding for that. So what Charles did was that he actually put a campaign around that, and he for around that one particular project that he wanted to raise money for, and he rolled it out, and it immediately went viral. So he got the money to do this project, to execute the project, and he also got a lot of interest from other teachers, because this was a phenomenally new way of raising funding. So it became so successful that Donors Choose has, I think, funded more than 1.7 million classroom projects till date, and has raised more than $1 billion in funding. So this was pretty much the start of crowdfunding as we know it. So what crowdfunding really means is that it's really community funding, right? In case of Donors Choose as well, it who was the community that Charles was reaching out to? It was probably the teachers, the parents of the children, friends, alumni. So what you really need to think is, what is that natural community that cares for your cause, right? Because that's the community that you have to reach out to for the purpose of crowdfunding. So let's say you work with cancer patients. The natural community for that would be to reach out to people who've recovered from cancer, or to the friends and families of cancer patients. So think about what's a natural community that really cares for this cause. And if you have a large enough audience that you think you can monetize, by all means, you should go ahead and do crowdfunding. Now, another aspect that you need to think about is, if you can make this into very specific projects that you can crowdfund over time, right? You can launch multiple campaigns, which is again going back to the example of Charles Best of Donors Choose. He didn't go out and say, I want to raise funding for the school. What he instead said was that he needs to go, he would raise funding for specific projects. Okay, I want to raise money because I want to take the children out for a science excursion. I want to raise funding because I want to buy these books. It was very specific projects, and he did that multiple times over. So if you can think of a large audience that would support your cause, but break down your campaign into multiple campaigns of specific projects, then the chances of really getting this source of funding are to making this a success are a lot higher. And you can really integrate this into your website as well, where people come in, you make for Donors Choose, which is $1, you can just start with $1. So you can think about it from that perspective and really integrate it into your website as well, and have this as an additional source of funding over and above what you're already doing. So that's crowdfunding. Now, another very valuable but very underutilized form of raising funding is basically sponsorship. And what does corporate sponsorship really mean? It means that you put yourself up in front of a corporate or an organization, and you ask them to make you a part of their CSR or their marketing branding, initiative. So you go to them with a certain asset in mind, and you ask them to put their name behind it. So what they get out of it is, of course, a tremendous branding and marketing opportunity, which Mark was talking about just some time back, when he gave you the example of Deutsche Bank, and also a feel good factor of being associated with a top notch organization, top notch social organization. Now, there are certain things that kind of differentiate sponsorship from other sources of fundraising. So when you're talking about sponsorship, yes, you go ahead with like an asset. And when I say asset, it has to be a marketable asset, right? So it can be tangible and intangible. What I mean by that is, if you are running a school, if you're running a clinic, which is a tangible asset, which a company can put their name or logo behind, wrap it up and put it in front of a prospective sponsor. Also, it works for intangible assets. So if you have workshops, if you have scholarships, if you have training programs, anything that is marketable, that can be packaged as a product and put in front of a sponsor, I would urge you to go ahead and do that, because this is a fabulous way of not only raising funding. So you can raise funding when you put your asset up for sponsorship, but you can also get a lot of non-financial resources, because it also includes pro bono. You can get volunteers to come and work for you. You can get donations in kind. You can get products in kind. So there are various ways over and above financial resources that you can generate through sponsorship. So as I mentioned, what you can offer to be sponsored, it could be scholarships, it could be your staff. So if you're running a medical clinic, your staff could be wearing, a T-shirt with the logo of your sponsor. Your doctor could be, sponsored by a particular organization. It could be buildings or vehicles, or it could be, programs, scholarships, training programs. So I'll just quickly take you through an example of another Ashoka Fellow by the name of Arnold Ruskin, who runs an organization called Mobile School. It really stemmed from his observation that more than 90% of street children, if you take them to an organized setup for education and for rehabilitation, they actually run away in less than 2 days, right? So instead of doing that, what he decided to do was to bring classrooms onto the streets, into their natural environment. So what he does is that he takes these vans called mobile vans, and he takes them to the streets, and they just open up, as you can see in the photo. They just open up, and there are like blackboards with like hundreds of exercises and fun-based games around it, for the purpose of teaching children on the streets. So what Arnold was earlier doing was that he was raising. So this organization raises no revenues. There is no commercial angle, commercial operations that Mobile School does. So what Arnold was doing earlier was raising all funding in the form of grants, right? But then he realized that he actually has a tangible asset in the form of these mobile vans that he can offer to a sponsor to put their logo behind it. So with mobile vans, the logo of the sponsor goes in, and that way he got more funding over and above just grants for his organization, right? Um, so very quick recap on the types of finance again, and when to use those finances. So if you look at your different PSPs, you can understand that for this sort of a business or for this sort of a project, this is the type of finance that is best suited. So for equity, as I mentioned, it is suitable for high growth businesses, early stage businesses which are risky but have a lot of potential for growth. That's when equity investors like to come in. When it comes to debt, it is for maybe more mature projects which have a stable, steady income. When it comes to grants, it is for those projects that don't have any commercial revenue coming in, and it's for social impact only. And when it comes to crowdfunding, if you have a community to sell to, and you can package your projects into these different campaigns, should go ahead with crowdfunding. And when it comes to sponsorship, it is primarily if you have a marketable asset, a tangible or an intangible asset that you can package and put in front of a sponsor. And again, it can be for both financial as well as for non-financial resources. Because ultimately, when you're looking at increasing funding for your organization, one way is to raise investment and get more money in. The other way is also to reduce your costs, right? So sponsorship becomes a great way of reducing your costs. You get an organization to come in and take in a part of your costs away. Somebody can come and really sponsor your new clinic or sponsor your staff, so a huge portion of the costs can be taken away by a sponsor. Okay, I think I'm just going to pause over there. I've just given a very quick overview of the different types of finances and when to use them. Before moving on to mix and match, if there's anything someone wants to raise, or Mark, if there's anything you want to add to this.
No, people are asking some questions in the chat, but Mark has answered it. People, please
Okay,
feel free to continue to ask questions via the chat, and Anshul, I'll let you know if there are any more questions coming in.
okay, sure. Okay. All right. So now that we've identified the different types of financing and what type of PSPs or projects are best associated, the third step is to really mix and match these with the right kind of funders. Because how it really goes is find the right type of funding for the right type of project, and get it from the right type of funder. I mean, that's the perfect flow of how you should be looking at unlocking not only more capital, but also capital from more types of funders. So you can raise different types of funding for different projects. And if I just go through the Access Afia example to clarify this, a bit more. So if you remember, Access Afia runs a vaccination program, and this is a program which generates no revenues. It's not a commercial program, and they would like to vaccinate 10,000 children, but they won't be generating any revenues for it. So maybe I should just ask everyone, what do you think would be the best source of funding for a vaccination program for Access Afia? You may I can't see the chat, so unfortunately I won't be able to read
I
any
can
of the
say it for
things.
you. Grants.
Okay,
Someone wrote
yeah,
grants. Yep. Foundations, Jonas says.
okay. No, that's absolutely right. So definitely,
Sponsorship,
yes.
grants.
Absolutely. So definitely grants, but also sponsorship. Because when it comes to the vaccination program, there are assets within that which are marketable and can be put up in front of a sponsor. So the refrigerated van can be one that can be taken to a sponsor. Also, the vaccines can be sponsored by a medical company, or whoever it is, or the staff. The training of the staff who are going to deliver the vaccines. So while you think about really finding a funder for the program or the product or the service, you can also go in a level deeper to see if there are assets within that, right, that can be funded as well. So if they're not able to find a grant maker to provide funding for the entire vaccination program, they can also look at sponsorship, which would help them to cover the costs of the components, right, of the refrigerated vans, of the vaccines, or training of the nurses or whoever is going to deliver that. So definitely grants and scholarship when it comes to the vaccination program. Next is the micro clinic. So just to remind you, micro clinics are, this is how they are delivering the service to the people in rural parts of Nairobi. And these clinics, because they cater to the poorer population, they're heavily subsidized. So there is some element of revenue generation. These are operating clinics, and they have a business around them, but the fee that they charge is very, very less. So they barely just break even, right? So they don't generate a whole lot of revenue or profits, but they break even, and because of the fact that they give their service out at a very, very low rate. So again, quick question: what do you think is the best way to raise funding for microclinics?
Loans, Jonas. Debt. Those are the three questions, the answers that came in.
Perfect. Yeah, that's absolutely right.
Sponsorship,
Yes,
someone.
yes. That's right. So soft loans, definitely, because they are breaking even. There is some level of profitability that's coming in, but not high enough. So soft loans, which can, or impact loans for that matter, which where the lender agrees to a slightly lesser rate of interest, given that these micro clinics don't generate a whole lot of profitability. So softer loans, and definitely sponsorship again, because you have those marketable assets over here that can be provided to sponsor. So the clinic can be sponsored by someone, or the staff can be sponsored, and again they can be wearing t-shirts with the name of the sponsor. The equipment can be sponsored. So again, look at the level of the micro clinics as well, where you can get soft loans, but you can also, in addition to that, look at the level of the different assets within the micro clinic and see if there is a sponsorship, or for that matter, any other option of raising funding. But definitely sponsorship, because you can get sponsors to come in and brand those clinics, or the doctor, or the staff, or the equipment, the diagnostics, or whatever it is. And the third is the pharmacy business. Now, this is they sell these products, they sell the medicine. This is a high margin business, so high revenues, high profitability. So again, what do you think would be the best source of funding for the pharmacy?
Equity or debt? Equity. Those are the answers coming in, Anshul. Equity or debt?
Yeah, that's right. So definitely equity, because this is a high growth business. There are high revenues, high profitability. An equity investor would be very interested in backing something where they can generate a high amount of return. And again, coming back to sponsorship, which we've talked about, even the pharmacy can be sponsored, right? And again, you can even get the medicines to be sponsored by a medical company. So you have to think of different ways when you think of the different programs, or the projects that you run within an organization. You think about the different types of funding options that are there, what gets associated the best with that type of funding, with that type of project, and then who would be the right funder for that, right? So you do mix and match in the end to get the best capital mix for your organization. And that's really the key to unlock more capital, and reach out to more investors, more funders, because there is no one sort of a solution that works for everyone over here. Funders do come in with their own requirements. They have their own risk return profiles. You cannot offer one thing to an investor, and the same thing to a grant maker, or whatever it is. You have to mix and match, figure out which is the right project, what is the right type of capital that gets associated with that project, and then reach the right funder for that project, to really increase the amount of capital that you can raise for your organization. So yeah, so by splitting the funding needs out into different projects, Access Afia can then find different funders for different projects. So we can again do this exercise. You've already identified the different projects, or the different, PSPs, as we were calling it earlier, the different products, services, and programs in your organization. Now, given what we've just discussed, what I would request you in your exercise is to identify the different type of capital that will get associated with that project, and so what funder to would be suitable to fund that particular project. So I don't know if there are any questions around this, or can we just move into the exercise? We can do a
No,
10-minute.
a quick remark from Ricardo, who says that we need to make sure that we protect the mission, because equity is
Absolutely.
there's a risk of mission drift.
Absolutely.
And so yeah.
Absolutely. That's absolutely right, Ricardo. And it becomes very, very critical for social organizations. I mean, equity, no matter which organization takes equity, it's basically bringing in a owner into the business, right? And after a certain point, you will be taking business, or decisions along with that, with the equity investor. But when it comes to social organizations, it becomes a lot more critical, because what is the most important thing for you to do is to be in line to deliver your social mission, and you don't want an investor to come in and throw you off road. So definitely becomes very, very critical to get a very mission aligned investor. You don't want the investor to come and say, stop the vaccination drive, because that doesn't generate any revenues. So it's very very critical for social entrepreneurs to be very sure of what kind of investors they are bringing on board. They have to be mission aligned so that there is no drift that happens in the future. And we have seen many cases of fallouts happening and things turning ugly. So this is a very, very critical thing for social entrepreneurs when they think of raising equity from external investors. And there are also ways of really protecting your organization as well. How to lock the mission. And we will be taking everyone through in our 4-week course on how you can lock your mission before you reach out to investors. There are various ways of structuring things legally and otherwise to protect your mission, but it's very critical. Thanks for raising that point.